In this video, I'm going to be discussing with you very quickly how to use structured expectation to hack consistency in forex trading. You see, if you have not gotten to the level that you are confident that you will consistently make money in your trading endeavor, trading might not really make any sense for you because in the forex market, losses are inevitable, and because of that, just imagine that you are not confident that on a consistent basis you will make money, and you now run into maybe a losing streak, maybe the first week that you want to probably start trading that your capital. How will it be? And this is why a lot of the times when people fund their accounts, one of the one or two, the first two trades or three trades, ended up being a losing trade, and they lose confidence in their trading system or strategy. And of course, they will now run back into what we call the circle of doom, where they will feel, let me look for another strategy that I believe can work. And this is because their expectation of wins and losses are not structured. So in this video, I'm going to quickly just have a discussion with you on how do you use how to use structured expectation to hack consistency in the forex market. This is very crucial. I believe that anybody that gets involved in the forex market, your focus should be that you want to be making money on a consistent basis. It will not make sense to make money maybe the first 2 months, and after the first 2 months or the first 2 weeks or the first 2 days, and after the first 2 days you start to lose money, and you will now eventually give up on forex market. What we are pushing out as a platform is to ensure that we make informative or educative information available to both existing traders and of course intending traders on how to approach the market professionally and to make money on a consistent basis. So one of the things that is important and is very central in the discourse of consistency in the forex market is the idea of what we call structured expectation. And I'm going to be using one of our trading system as an example, and I'm going to show you how we structure our expectation when it comes to this particular trading methodology. And that is what I call cash flow money box trading framework. Trading framework. So in case you have been following, you know, you have been following us on this YouTube channel, you must have heard me talk about this trading framework. This is the trading framework that we use to make money in the forex market on weekly basis, on daily basis, as we see opportunities available in the market. And of course, in addition to this, we still have two other trading framework. We have the project framework, and we have the investment framework. And of course, not to make this video too long, let me just go straight into what I mean by structured expectation. Now, when people come into forex without a structured expectation, it's going to affect their response to the reality of the market, in that if you have losses, it's going to affect your confidence a lot, because your expectation is not structured. And even if you now have wins, it will still make you to those wins will get into your head, and of course, definitely you might be misbehave at the end of the day. And when you now run into losses, you will think that something is wrong with you. Now, using this particular framework or trading framework as an example, I want you to listen to this very carefully. This framework is a trading system, not a trading strategy. So whatever framework you will be using, should be that it's a subset of a trading system. This is very important, and it's because a lot of times people just have what they call trading strategy, and that's the only thing they have. So if what you have is trading strategy, it means you might not be able to, engage what we call structured expectation to have consistency. What do I mean if I say trading system? Your trading system is different from just a trading strategy in the fact that trading system should have some things. Number one, your trading system should tell you the assets to trade or tradable assets. So this is what we really distinguish between trading system and trading strategy. So remember that I said that for you to engage or apply this concept of structured expectation, you must have a trading system, verifiable, a trading system that you have tested and you are convinced that you have edge in this particular trading system. So your trading system must clearly define the assets to trade, tradable assets. This is very important. Number two, your trading system should have a clause that shows or that explain the risk management or risk management framework. This is very important. Number three, your trading system should clearly explain the trade management framework to be used. And of course, your trading system should tell you clearly clear entry and exit conditions or rules. This is very or rules. Then lastly, you now begin to talk of structured expectation. You see now, you will notice I said that if what you have is a trading strategy, you might not be able to apply the concept of structured expectation. This is because whether you apply it or you can't even, you won't have the psychology. Your psychology will not be in check to be able to apply what I'm about to discuss with you. So it means that before you start to talk of structured expectation, you must have a trading system that you trust. It's very important. And of course, I said that I want to use this particular trading framework. This is one of the trading framework within our trading system, the cash flow money box trading framework. I want to use it to explain to you what we mean by structured expectation. Of course, you must believe me. I mean, you should be rest assured that for this particular trading framework, we have our tradable assets. We already know what to trade because at Potential Miners International, we engage in an holistic analysis where we identify the assets to trade after we have done our fundamental analysis and we have done our sentiment analysis before we now get to the chart. So it's a threefold analysis that we engage, and what we do when we do fundamental and sentiment analysis is to identify the tradable assets. We call it our identification and optimization protocol. You see, so our trading system already identify what should be traded at any point in time. So we have our clear risk management framework, we have the trade management framework, and of course, the entry and exit condition are clearly defined. So if you have something like this as a trading methodology, then you can now use structured expectation to hack consistency. What am I talking about? At Potential Miners International, we trade in clusters. We trade in clusters. So one cluster is equals to 20 trades. 20 trades. So it's on the basis of this 20 trade that we structure our expectation. So for the cash flow money box, our expectation is inked on a 40% win rate. You hear me? A 40% win rate. And this is how we structure our expectation. given the fact that we trade in clusters, so what we do is that on the average, even when you want to overly risk your capital must be able to take 20 trades. This is a subset of our risk management framework anyway. But what we are saying is that at Potential Miners International, an average account will take minimum of 20 trades before you can talk of blowing an account. So at Potential Miners International, literally it's impossible that you will blow an account, except if you don't trade by our trading system or trading framework. So we have 20 trades. You must be able to take 20 trades with your account. That is when you are doing aggressive risk management. You get that now, which means you are risking 5% on every trade. That is aggressive risk management. That's just by the way, but our focus in this video is to explain what structured expectation means and how it can help you to hack consistency. Because if you cannot take the trade and take the trade again and again, regardless of whether the last trade was a loss or a win, you will never be able to make money consistently in the forex market. So when you structure your expectation, whatever the outcome of any trade is will not really affect you. That's what we are talking about. That's the full gist. Now, we have 20 trades. This is how we now break it down. So breakdown of expectation. And this is what we call structured expectation. Now, it means that since our trading framework says that our expectation of win is 40%, so which means, of course, let me quickly say this, for this particular cash flow money box, our risk to reward ratio is 1 to 3, equals 1 to 3. So in case you really want to just overview this trading system alongside my discussion, so that you will know why, if you are saying 40% is our expectation of win, what kind of trading system is that? We have structured our expectation around 40% win rate. And of course, on every trade, we risk 1%. If you are risking 1%, you risk 1 to make 3. If you are risking 1%, you risk 1% to make 3%. If you are risking 2%, you risk 2% to make 6% on every trade. If you are risking 5%, you risk 5% to make 15%. So now, how do we now break down our expectation? What this means is that on every 20 trade, we are expecting that we expect 20 trades, we expect 8 wins and 12 losses. You see that now? On the overall, we expect 8 wins and 12 losses. But this is not where we are going to stop. We are still going to break it down to say that out of every 10 trades, this is 20 trades, out of every 10 trades, we expect 4 wins and 6 losses. Of course, we are not still going to stop there. We are still now going to break it down. This is how we structure our expectation. 20 trades, we are still going to break it down, or we still break it down further to say out of every 5 trades, we expect 2 wins and 3 losses. And of course, we will now, this is the last breakdown now. We say that out of every 3 trades, we expect 1 win and 2 losses. Now, if you want to trade with this particular trading framework, this is one of our trading framework. Within our trading system, we have 3 trading frameworks. You see it now. So now we have the cash flow. This is one of the cash flow trading framework. Now this cash flow trading framework, our expectation of win is 40% and the risk to reward ratio is 1 to 3. Now we now structure our expectation to say that given the fact that at Po ten tial Miners International on the overall we trade in cluster, which means every account must be able to take 20 trade before you conclude on whether you have made a profit or made a loss. Now within that 20 trade, we expect that you have a 40% win rate. This is a worst case scenario. You get that now? So which means that Po ten tial Miners International, if you apply all the rules as spelled out by the trading system, you are not expected to blow any of your capital. You can have drawdown, you can have losses, but because we have structured our expectation, you will just be relaxed. What do I mean by that? Or what am I talking about? Imagine that you know that out of every 20 trades, you are expecting 12 losses. So if you take 3 losses, you will still know that you have 17 trades to take. So there's a way you will be relaxed. Let's say that you are focusing on 10 trades now. Out of every 10 trade, you are expecting to lose 6. So if you take the first trade and you is a losing trade, you take the second trade is a losing trade, you are still relaxed because you know you still have 8 trades to take within the 10 trade. This is just a breakdown of our expectation. Then of course, out of every 5 trade, you are expecting to lose 3 trades. So if in a week you are able to take 5 trades, on the overall the first 3 trades can be a loss. You are expecting that if you fall on the positive side of probability, the remaining 2 trades for the week, if you are taking 5 trades in total, should be a win. And this is how we structure our expectation such that the outcome of any trade is not going to get you off balance, to say that you will now lose confidence in your trading system. A lot of traders, do not have this type of structured expectation in their trading methodology. And this is why, oftentimes you will see them, they will use this strategy today. If they have maybe 2 losses, they will move to another strategy. Before you know it, eventually they will just blow the account. So this is how we approach the market at Po ten tial Miners International. We have a trading system that spell out the tradable assets after conducting identification and optimization protocol. We have our risk management framework, clearly spelled out. We have the trade management framework spelled out. We have the entry and exit rules spelled out. Then we now have the structured expectation. If you can, look within your trading methodology and see how you can incorporate a structured expectation such that the outcome of any trade will not really affect your confidence, this is going to help you to hack consistency in the forex market. And I want you to really try this out with your trading methodology. However, if you feel you don't have a trading system, and you feel okay, maybe I should even use the trading system of Po ten tial Miners International, of course, is either you contact me, in the comment section of this video, or you just watch series of our videos that we have released. It's for free. You can still watch it for free and see how you can follow. If you can really follow, we release all this information for free. However, if you want to go a step further to say, I want you to take me by the hand and show me how you do your analysis, how you identify the tradable assets, of course, you can reach out to us and of course, we'll show you how to go about it. Until I see you in the next video, I remain Mr. Akimbode Damilola, the King of Waves. Thanks for listening. God bless you.